In this week's update, what are the odds of a larger correction? Sentiment has shifted a lot. And what you should do now. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. A really interesting week, I think I can say without any doubts at all that the character has changed. It was certainly shaping up that way a week ago, and the week that we've just had was certainly more negative, confirming that. But it's still about valuations. This is a reset around valuations, and part of it is also about the Fed and rate cuts. This is not about a change in the fundamentals or the outlook or anything of that nature. And the reason that that's so important is because it makes it far more likely that this will be relatively mild and shorter term rather than something really quite nasty. So for me, it's about rotation. It's not about money deserting the market. There really is virtually no sign of that occurring. It's about rotation, just moving to other areas. And given the run that we'd had, particularly in technology this year, such a rotation is absolutely stock standard normal. So it's really important not to go looking for things that aren't there. However, that's not to say that some actions are not necessary, because the adjustment still could be very sharp, or it may not be. I have no idea, and I specifically don't think about it because it's not helpful. In fact, it's actually a negative. So my view is that it'll be relatively short term, and we'll just have to see how it plays out. But it's also really important that investors understand who they are as an investor and that they play it depending on the category that you fit into. And I addressed this in part last week. So this is the time where it's absolutely critical that you know what sort of investor you are. Are you the more conservative, nervous kind of investor, don't take too well to volatility and corrections? And if that's the case, then that's absolutely fine. Just be honest about who you are. And then the other kind of investor doesn't worry about shorter to medium term corrections too much. They just sail through them, confident in the stocks that they own. And then there's a whole bunch of people that probably sit in the middle. They're okay with the volatility, but given the opportunity, they'd probably cash up a little bit to take advantage of bargains. So it's important that you understand who you are, because the actions, depending on which category you're in, are very different. They're completely different. So there is no one-size-fits-all approach to the market. This is about acting in a way that allows you to be comfortable with what's going on, whatever that may be. And the important message here is that we don't need to know what comes next. So many people who are non-members contact me, and they have this underlying desire for me to help them understand what comes next. I don't have a crystal ball, and a crystal ball is just not helpful anyway. And if you do decide that you need to take some action because of the way the probabilities are looking, then now is the time when you should do it. Don't wait and see how it unfolds, because by that stage, a good part of the damage would have already been done. So be decisive, decide what needs to be to make you feel comfortable in the market, and get on and do it now. Don't wait and see. That's the worst thing you could do, because that then leads you down a path of selling somewhere near the bottom. I think there are two choices when looking at the market, and I've been examining this very closely and every day looking through hundreds of charts, because that just gives you so much better flavour on the market. So for me, there are two choices that I can assign probabilities to at this point in time. The first one is that this is just a valuation reset, particularly with high multiple tech stocks. And there's also probably an element of repricing the market because the odds of a Fed rate cut in December are now lower. So I think there's a bit of each, but more of a valuation reset. But then when you look at it, it's challenging for market players to make a decision, because we've got really high multiple stocks, but their earnings are really strong. So what do you do with that? What is the balance? Do you bring the multiples down a bit and then allow the earnings to catch up? Just how do you play it? And the answer, of course, is we don't know, we'll never know, but we can control things that are within our control. Our weightings, our stock selections, our method of entry, our method of exit, all those sorts of things. So your exposure at this point in time depends heavily on who you are as an investor. And the choice that you might decide could be anywhere from cashing up to 40%. I think beyond that is just not required at the moment. Things just don't look that bad, like they're going to turn ugly. So I think anywhere from 40% cash to basically no cash, fully invested. And the answer is so much about you. It's not about someone like me telling you what it should be. I'm just giving you the indicators as I see them and trying to give you a thinking hierarchy, because that's far more valuable than just tossing you a fish. Just be sure in this market that what you own is a high quality stock or a good stock in inverted commas. If that's your starting point and you've got your timing a little bit wrong, then just wait it out. It makes it so much easier if all you own is high quality, high probability growth stocks. It then just becomes a matter of timing. The second choice, so the first choice is valuation reset. The second choice is that this is a meaningful top. This whole AI bubble narrative is actually correct, and we're going to get a significant correction, particularly in tech stocks, something like what we saw in 2022, where tech stocks basically went down for 12 months, and that we're going to get a significant correction. So that is the other alternative. I wouldn't write it off, but I think it's low probability. So this is where the AI bubble narrative takes over. It drags money out of the market. We're not just having a rotation from one sector to another. We're actually dragging money out of the market. It's going elsewhere into the bond market. So for me, there's no question the odds have shifted. And if I wanted to hazard a guess at the moment, I'd say 75% on the top one, valuation reset, and 25% on the second one. But that's just a very broad brush way that I'm seeing it at the moment. That could change next week. The important point is, whatever it is, it doesn't matter. We don't need to know. We are better off not knowing, because once you think you know and you formulate a plan in your mind, it tends to make you blind to what the market is telling you, because you've already decided that this is the path. So it's actually far better to not have that decision lurking around in the back of your mind. And your success as an investor is just so much about the mental side of the game. So the most likely outcome for me, looking at all those probabilities, is that it's a correction, but it's not too much of a correction. Might be sharp, might be a bit slower, doesn't matter. It could well be that current high multiple stocks don't get dragged down dramatically, that the PE multiple doesn't fall from 40 to 20 or 80 to 40 in a very short space of time. What happens is the multiple contracts a bit, but because earnings are growing so strongly, it comes back into line over time and does it fairly quickly. I think that is where I'd be putting my money at the moment. And that's a pretty easy sort of market to negotiate as long as you don't panic at the front end. And it's really just simple, everyday, all market behavior. 3 steps forward, 1 step back. And remember that whatever you read, there's a lot of very negative press and has been now for a couple of months. Whatever you read is meant to lure you in. It's clickbait for a story. It's not to accurately inform you of what's going on. So when you're reading mainstream press, don't think that it is something that has validity, because you just don't know what the motivations are of the person that's written it. And anyone who's making predictions about the market, and there's a few high-profile shorters out there at the moment making the call, they're doing it for reasons of notoriety, not to inform you accurately about what's going on. This comparison with the late 90s tech wreck is just clickbait. It's irrelevant. It's not even accurate. There's not even any real validity to it at all. Now, this is what I wrote last week, and I don't think that anything's changed. These are the actions to consider. Demand lower entries. That's within our control. We can do that. Never feel like you're missing out. Just be mindful there is a rotation happening, so don't be too quick to buy into the first leg down, because chances are there's going to be a little bounce and then another leg down. But take advantage of it. Just be more conservative on your entries. Now, we're not there yet. A broader, deeper correction where the indexes go down by 20% or 30% across many sectors is inevitable. It'll happen. I don't know when, and I don't think about it. But significant action at this point in time can't be justified. So this is what I wrote last week. But some portfolio preparation could be, and that's what I'm still talking about again. Identify stocks that you might have at risk. First of all, identify who you are as an investor. Then what are the stocks that are at risk of a significant fall? Often the market darlings are in that category that have got excessive valuations. And just do that. And don't buy what's expensive, or don't buy a stock because it's just fallen 20% and you hope that this is the bottom and it turns around. This is not the time for those kind of trades. Now, let me just show you some charts to give you a sense of what I'm seeing. So last week, this is with AMD, and this is where AMD sat last week. This green candle here, which occurred on the Friday reversal. What I said was it was far more of a sign of a robust market. Major tops, where fundamentals have changed, are not orderly. There are no signs of panic here. Now, following that, we got a pretty negative week. You can see every single day closed lower. And we still haven't filled this very large gap down here yet. So there still could be some more work to the downside. So that tells us that the week that's just gone has been far more negative than what preceded it. This is Amazon. I wrote last week that the character has changed. There was a huge gap on earnings, and we filled the gap. So that's where we were sitting last Friday. We'd only just poked our nose below the support level. Well, again, almost every session except the Friday was a negative session. And the volumes were certainly rising. See, the volumes rose significantly from the week before. So again, no question, the character of the market has changed. This is a really interesting chart to look at. And don't worry about the stock. It doesn't matter. It's just the price chart. Look at the period from here in April to, let's say, here on the 23rd of October. Look at the size of the candles. Look at the progression. Now, we move into this period from the end of October and see how much more volatile it is. We've got gaps left, right, and center. The candle ranges are far longer. The volumes are far greater than anything back through here. So no question the character has changed in an uptrend. Now, how does this resolve? Does this resolve by a high-level consolidation, or do we get a retracement back to the breakout? Now, this is a bit of an extreme example in terms of what happened in the previous 6 months to what's happening now, but there are a lot of stocks that look more like this than like this. And finally, of course, I have to look at NVIDIA. The NVIDIA results got a lot of press. They were good. They were beating on both top and bottom line. And the market initially loved it, went up 6%. But then there was a rethink. And I don't know why there was a rethink, but I guess perhaps the mounting amount of negative narrative around the AI bubble just took its toll. And NVIDIA didn't go up on Friday night as would have been expected. So there we go. We've got a change in the market, which is undeniable at this point in time. It's what follows from here that's important. And as always, we recommend that you get all the investment advice, financial, legal, any other advice that you require before acting on anything in this video, because this is just purely general advice from someone who's been in the market for decades and decades, and I guess can see things more clearly than perhaps less experienced investors can. Let's look at the American market. The S&P gave up 2% and the NASDAQ 2.75% for the week. The Russell was down 0.8, and that's quite significant that the Russell fell far less than the main indices. And that again plays into my conclusion, based on what the market is telling me, that this is not a desertion of the market. Because it would appear on those numbers that some money, at least, has rotated out of big tech and it's gone into small caps. That's where it's gone. Now, that is not the sign of a significant market top. It's just not how markets behave. So that reinforces what I've been saying over the last few weeks. The other point that I'll note, which we'll look at when we get to the chart, is that the Friday bounces. This was the third Friday in a row where the market has bounced on the Friday after quite a poor week. But the bounces are weakening. They're getting less and less, and you'll see exactly what I mean when we get to the charts. So therefore, I circle back to where I start. Where do the probabilities sit? The odds favour short-term valuation reset, which means that you're not necessarily buying the dip, because that suggests that you can move quite quickly. I think you need to be a bit more cautious than just buying the dip. But I think what we're going to see are great stocks being presented to us on a plate at a much better opportunity than what we've had over the last 6 months. So net, my position is that we're going into a period of opportunity, but one where you've got to be a bit more cautious, because I wouldn't close the door on a sharp move in the near term. And all this is just consistent with the fact that we've got robust earnings. You can't deny that. And there are no structural changes in the market. All we've got is essentially two things. We've got a bit of disappointment that rate cuts aren't going to come in December, or may not come in December. The odds have fallen a long way. And we've got a valuation reset on a bunch of stocks that the market just punted too hard to the upside. There's nothing wrong with those businesses. It's just the market made them more expensive than they should have been. So that is just a normal bull market correction. The US dollar index has punched up through 100 and held that for the week. That impacted commodities, of course. The 10-year yield fell a little bit back to 4.06. The VIX did spike to 27 during the week, or a bit over 27 at the peak, and finished on Friday at 23.4. Now, anything above 20 still tells you that the market is jittery, still nervous, and that's why we could still get some sharp volatility. Let's go look at some charts, and we'll start first of all with the NASDAQ composite. So you can see, let's look at the 3 Fridays. Here's the first one. We gapped to the downside, traded down, and then traded up and closed right on the high. Okay, it was down for the day, but it still closed on the high of the session. Let's move to last Friday, or the Friday before last. Again, we traded down and then reversed, went right back up again into the positive, but a little bit of selling emerged. So this one, not quite as strong as this one. Now look at what happened on this Friday night. The futures were actually a little bit higher starting at the open, traded down, traded up, and then finished pretty much where it started. So that is weaker than that is weaker than that. So as we start to go down, the bounces are getting weaker, and that's just consistent with what you'd expect to see. So this is all rather predictable to me. Let's look at SMH. So the semiconductors. There was certainly some sharp selling on Thursday, and that was a bit about the intraday sell-off in NVIDIA, which then filtered through to all the others. Inconclusive finish on Friday. So the jury is still out there for me, but certainly you look at the volumes of the last couple of weeks, they're certainly up. So I think we've seen the top in the semiconductor market for a little while now, whether it's just a mild consolidation at this high level or whether we get a deeper correction. That's just about risk management. There's nothing particularly difficult about that. On a relative comparison basis over the last fortnight, in fact, let's start a month out to get a better sense of it. So healthcare has certainly moved to the top of the tree. Energy had a good run, but the last couple of weeks have been down, as we'll see when we get to that part. And they're the only two sectors beating the S&P. Finance comes next, so pretty much in line with the S&P. And then we've got industrials, materials, consumer staples, and then we get to consumer services, technology, and consumer discretionary, the most aggressive parts of the market, all at the bottom. And in the last 2 weeks, that order hasn't really changed a lot, except that staples, there's a lot more money now moving into consumer staples. So healthcare and staples, the outperformers. So the market is definitely rotating more defensively, no question about it. If we look at the Australian market, the last month, we've got energy at the top, but weakening over the last month. Then we've got materials also next in line and weakening. In fact, everything here is weakening. Small caps. There's the ASX 200, so they were the only three parts to beat the index. Finance underperforming the index. So was healthcare, and of course technology right at the bottom. Technology's been hit very hard because that contained quite a number of those high multiple stocks. Let's just zero in over the last fortnight to see the change. You can see everything has fallen, but the order is pretty much the same. A little bit more impact on small caps. Now, if we turn to the S&P, this is on a weekly chart. So you can see we got a bit of a recovery on Friday, but we've now had 3 of the last 4 weeks have been lower. But the next two charts are what I find encouraging. This is a bit of a savior. This is RSP, the equal weight S&P. So removing the impact of those really mega cap stocks. And we only got a very small decline, and we're just a whisker off the all-time highs. So this points to the probability of a shorter term valuation correction. And when you look at the Russell, this is on a weekly chart, but if we go onto a daily, you can see just how robust. Thursday, yes, everything got sold off, but Friday on really, really good volume, this was really quite strong. So that's how the US market lines up at the moment. Turning to the Australian market, the Aussie dollar, just a tick under 64. We're a risk-off currency. Our stock market tends to get hit during periods of global risk-off, which is what we've got at the moment. So that's not unexpected, but we also, of course, had the US dollar moving a bit higher as well. Our index was down 2.5% for the week. It was the 4th consecutive down week. And as you'll see in a minute, the ASX 200 is not looking too flash. The sentiment here is far worse, but I look on that as a real positive because we've got some outstanding growth companies that are going to make patient investors a staggering amount of money in the next decade. So for me, this weakness in the Australian market is a huge opportunity building, but I don't have much confidence that we're there yet. I think there could be some more to come because what we've seen so far has been significantly negative. So we've got a very clear rotation to defensives. And last week, I said this was a time to get back to basics, focus on megatrends, forget anything that's not in a megatrend. Pay attention to your weightings, both on a sector basis and on an individual stock basis. Just go and buy the best of the best. I mean, why would you do anything else? It's illogical. I get questions about all kinds of stocks that are not remotely the best of the best, and I wonder really where they come from. Ensure that you get good entries and ensure that you've got a clear exiting plan, and this is what we do every day of the week in the Insiders Club and to a lesser degree in Portfolio Analyst. So let's go and look at the Australian market. So the XJO. So this is on a weekly chart, so you can see 4 quite significant down weeks in succession. And the character of the Australian market has changed. All these candles are green. They're closing on or near their highs. Very few red candles. We start to run out of momentum up here, which was in early September. We have another go at it, managed to push to new all-time highs by the late October, and then the last 4 weeks has just been significantly down. So that is completely different to that. So don't fight it. Work with it. Cash up if you need to a modest degree. Set yourself up for the next phase. All right, let's now move to precious metals. Gold was down $19 for the week, but is still holding above 4,000. In Aussie dollars, we're almost 6,300. So that's significantly profitable. Silver was around about 50, did get up to about 53 during the week from memory, but that's still in solid uptrend. And this is a key resistance area here. So it's no surprise that silver is going into some sort of consolidation. And if we look at gold stocks, we've had a powerful surge in recent months. We're now getting some consolidation. And again, that's just normal. You know, I saw a report this morning that the run in gold stocks was over. I mean, that suggests that consolidation is not a word that has any validity to whoever wrote that. It is highly probable that what we're entering now is a consolidation after a period that just got ahead of itself. It went too far too fast because there are some fabulous projects out there. So let's go and look at the precious metals side of things. We'll start with silver. So this is on a daily basis. You can see it was only the 13th of November, so a couple of weeks ago, that we set a new high at 54.4. And things have got very volatile since then. You can see that the character here, in terms of volatility, the lengths of the candle, the number of red candles relative to green candles, the character is quite different to what it was back here. But again, that's normal. That's not a negative. That doesn't signal anything other than we're getting an overdue consolidation. There's the gold price on a daily basis. It's all been pretty mild. There was an initial fall on Monday, and then it was pretty mild for the rest of the week. In Australian dollars, that looks like a very strong trend to me. The pink line is an 8-day moving average. So it's managing to hold above the 8-day moving average, which is a sign of enormous strength. So that's where we sit with all those markets at the moment. Turning to other commodities, copper around about $5. And while some people are a bit disappointed about the fact that copper hasn't kicked on, that it's gone above $5 a couple of times and then pulled back, we're still 20% higher than we were a year ago. So you've just got to keep your perspective sharp on what's actually happening with copper, because the long-term outlook still remains very upbeat. And I think the biggest risk in the copper market is being underweight, not having enough. But that is a view from an investor who is looking out at least 2 to 5 years. If you're looking shorter term, then you might come up with a different answer. But for me, that's the risk, and I'm looking for opportunities to build my exposure into copper. But you've got to have a plan. You've got to know what are the best of the best. You've got to have patience, because it might be a year or two before this really starts to sizzle like it did with gold. I remember saying for well over a year that how frustrating it was that gold stocks were not moving in the way that they should, given the gold price was going up. And I think the same thing is repeating here with copper. So if you're good at selecting the best of the best, if you're patient, then I think there's some highly probable 10 baggers and above that are going to be emerging over the next couple of years. So I'm very excited about the copper market. If we look at crude oil, finished just a tick under 58, so we've now dropped over the last few weeks, and lower for longer seems to be the consensus. Supply is outdoing the demand, and so that is causing a reprice. And I don't like the energy market anyway because of the geopolitical unpredictable forces that are always at play there. I'd just rather not play in that market. And there are consensus targets now for West Texas Intermediate crude from 52 up to 56. So perhaps there's still a few more dollars to go to the downside. The overwhelming consensus seems to be that crude oil in terms of an asset class is probably a 2027 story. So I don't see any near-term prospects in that particular market. There's the spot copper chart, so you can see we're now consolidating around the $5 area, fluctuating at just above and just below. And there's crude oil still on the slide. We had a bit of a bounce in late October, but we've been on the slide for a little while now. So wrapping it all up, final message. This period of time, risk management is the absolute key. Don't try and predict, don't try and guess, don't look around the internet for someone to tell you what's going to happen, because that's just not the way to go about it. That will not lead you to success. Just focus on learning how to do risk management well, because we can never be sure about the future, and just ignore all the stuff that's been written because it's being written by people who can't be sure either. Understand clearly what it is that we can control, and that's most things, and just do that. Just control the things you can control with strong risk management. And that's about selection, it's about weightings, it's about clearly defined exit rules that can be applied unemotionally. We can control all those things and be more selective with the stocks. They've got to have strong balance sheets, unless they're an emerging stock where there might be specific things happening. You're looking for strong balance sheets and resilient earnings. The other alternative, which a lot of investors seem to think is the way to go, is to make no decision. So let's just see how it goes. Then we'll react as it unfolds. Well, I can tell you that what will probably happen is that where you start reacting is where you start to get worried, and that is probably closer to the bottom than it is to the top. So seeing how it goes is a really bad strategy. Know who you are, what you want from the market. Be prepared to sit and think and map out the journey for each individual stock, why you're in it, and then act decisively in a way that keeps you comfortable. And that's how you become a successful investor. Portfolio analyst last week, there was quite a bit of learning about what happened in the February-April correction and comparing it to what's happening now. And if you can't learn from history, then you'll never be a successful investor, because there is just so much to learn from previous corrections in the market. You don't learn anything in a bull market when all it's doing is going up. This is when you learn. So take advantage of it. All right, that's it for this week. There's more information on the website, and there's my email address. I'll be back with you then. Cheers.